A very good morning to all of you students. Let's continue our discussion on the topic of interest rate risk management. We will pick up from the last session, or maybe just quickly have a 2 minutes revision on what all topics we covered in the last session, and then we will keep the flow continuing. So, on interest rate risk management, students, we studied why interest is required to be paid because of two reasons. One is the time value of money, which is also called as inflation. And second one is the risk of non-payment, because if we lend money to someone, there is a credit risk, there is a default risk that is there. And hence, if the risk is higher, the interest expectation also becomes higher. Then we also discussed that interest rates are never static in an economy. Interest rates are always dynamic because there are a lot of factors which affects the interest rates. For example, the central bank's interventions, which is RBI, let's say they will notify the repo rate or reverse repo rate. Similarly, the supply and demand of credit in the market will also impact the pricing of the credit, which is effectively interest rate. Now, since interest rates are dynamic, so it might lead to a possibility that tomorrow the interest rate can turn out to be in a unfavorable situation, which might lead to negative impact on the financials. Correct. Now, to curb those impacts on the financials, we discussed about the different techniques of hedging such interest rate risk, right? So what all things we discussed about the two traditional methods. One was asset and liability method, second is the forward rate agreement. So asset and liability method, it's just matching the maturity profile of the assets with the maturity profile of the liabilities, so that there is a minimum need to invest or there is a minimum need to borrow. Forward rate agreement, we discussed that in case the borrowing or investing has to happen some time from now in future, then how will the instruments work out, right? What are the different payoffs, what different positions are taken, some of the valuation principles of FRA, and hence some of the techniques wherein if the FRA is overpriced or underpriced, right? So all these things we discussed in FRA. Interest rate futures are very much similar to the futures that we discussed in derivatives, with the only exception here that there is no future running on interest rate, but there is a future running on bonds, and bonds has an inverse relation to the interest rates. So we have to be careful while devising the strategy whether to take a short position or whether to take a long position. On interest rate guarantees, these were very much similar to the options that we discussed in derivatives. Here, the holder has an option, which is not an obligation, right? It's a right through which the holder can exercise in case of favorable conditions and make use of it. So we discussed about two different types of interest rate guarantees. One is the cap and second one is the floor. So cap is used where you have to borrow and hence it will help in capping the overall rate of interest. And second one was the floor, wherein if you need to invest somewhere, so it will help you to give you at least minimum return, which is the floor return. Then we discussed some of the questions around it. And today let's discuss about the swaps. Yeah. Any questions, students? Please do let me know till now whatever we have discussed. We will take our session ahead. Okay. Yeah. Good morning, everyone. Perfect. So on interest rate swaps. So let us assume a situation. We will build up our story through this situation and try to understand the swap through this. Okay. So let's assume there is a company A and there is another company B. Okay. Please hear this discussion very carefully because this will be going to be the basis of all the discussions on swaps, right? So this company A is a very well established company. Okay. They have good amount of profit making ability, right? And hence they internally they have assessed that they can prefer to borrow the money in a floating rate of interest. Okay, because floating rate of interest can mean that it can be lower or higher, it can go in either direction because interest rates are dynamic, right? So their preference is that they want to borrow the money in floating rate of interest because they have that ability, they have that capability in which the business can actually service the interest and principal payments on the loan. Okay, so they are okay with that. So they approach their bank, let's assume bank A. Okay, so bank A is saying that okay, I will give you two different proposals. One is if you borrow in fixed basis, on a fixed basis, I will charge you 7% per annum basis your credibility, basis your rating, basis the business performance, everything they have fixed it at 7%. For floating, in case you want to borrow floating with us, okay, we will take it as MIBOR. We will not add any spread. Okay. So students, we discussed about the MIBOR, right? In the last session, I'm assuming, let's say it's MIBOR or SOFR, whatever the case may be, but I just wanted to tell you that it is linked to some of the market rate. Okay. Because market rate is MIBOR or SOFR. Then company A says that, okay, let me evaluate both the proposals. Meanwhile, company B also is, let's assume, a new company. Okay, this is a very new company and they don't have established their profitability and everything yet. Hence, they prefer the borrowing to happen in fixed. They prefer fixed percentage borrowing. Reason being very simple, they don't want to undertake any sort of risk. Okay, because they are very new. So they approached their bank, let's say bank B. Okay, so this bank B also suggests to company B that I can offer you two different proposals. One is on the fixed coupon side. Coupon means interest rate. Okay, let's say 10%. And in case you want to go for floating, then I can offer you MIBOR plus 1%. Okay, so if you see, we have slightly kept the interest rates of bank B for company B higher because company B is a new company, right? And hence the risk will be higher. Clear? Now, if you analyze this situation, okay, for bank A and bank B in relation to company A and company B respectively, okay, so they have, see, one option is that they can just go ahead with the preferred borrowing, uh, whatever they want to prefer. For example, company A can just go and borrow at MIBOR. Company B can just go and borrow at fixed coupon rate of 10%, right? But then there is a role of swap bank here. Again, I'm just putting it as swap bank. It can be any bank. It can be either bank A, bank B, or bank C also. It can be, as per the arrangement, it can be anything, right? So now both the companies actually submit their proposals to Swap Bank. Company A says that okay, Bank A had given me this proposal. Company B says that Bank B has given me this proposal. Now see this visibility of what has been offered to company A and what has been offered to company B is with the Swap Bank, which is an intermediary, right? So what Swap Bank will do? Swap Bank will say that okay, we have two different options, right? In this scenario, we have only two different options. Option one is that fixed, we are asking company A to borrow in fixed, and we are asking company B to borrow in floating, right? So in case we do that, so A for fixed is 7% plus floating for bank B will be MIBOR plus 1%. So this effectively means that what is the total level of borrowing cost? I mean, borrowing rate at totality level, it will be MIBOR plus 8%. I hope students, all of you are there with me till now. Then the next one is the option two, in which let's see if we reverse the fixed and floating borrowing, then it will become floating for A plus fixed for B. Okay. So if we do floating for A, then we will be at MIBOR plus fixed for B will be 10%. So we ended up at MIBOR plus 10%. And let me tell you, this was the borrowing, individual preferred borrowing case. Sorry. Individual preferred borrowing case. Okay. So individually, if they prefer, they end up having a collective interest rate of MIBOR plus 10%. But if we just try to do some other option, then they reach at MIBOR plus 8%. Clear? So now, if you see, the bank will clearly select. So this swap bank has this visibility, right? So what this swap bank will do, okay, swap bank will say that, okay, let me ask them to borrow in this, right? But at the same time, now if the borrowing happens at this manner, then swap bank has also to satisfy the company A and company B preferred borrowing preference, right? So for that, what it will say? It will say that, okay, let me just draw it over here. So first of all, company A needs to borrow the loan at fixed 7%. So this is loan taken, and this is the 7% interest rate that will be paid, right? Because we are going ahead with option one, right? Because this has a overall lower cost. So 7% loan will be taken by from bank A by company A. Company B will borrow and take the loan. And in this entire scenario, I'm assuming the amount in question is same. The notional amount is same. Let's say both of them are talking about 1 crore, 10 crore, but it's actually the same. Then company B will pay to the bank as MIBOR plus 1%, right? This is what the arrangement is. I hope I'm clear till now.
Yes, sir.
Perfect. Now, now let's see what does swap bank will do. So now swap bank will say that now company A will go to the swap bank and say that now see you have made me borrow in fixed, but my preference was in floating. So swap bank will say that okay, You pay me the floating rate equivalent MIBOR. Okay, since you have a preference to borrow in floating, you pay me MIBOR, and I will pay you in return basis some calculation. I will tell you how that calculation has been arrived, but as of now, don't focus on that. As of now, just focus that basis some calculation, the bank has arrived at 7.75 percentage. So the swap bank will give it to the company A, and it will take MIBOR equivalent interest rate from the company A. Clear? So swap bank will say, okay, company A, you pay me MIBOR equivalent percentage of interest, and I will pay you in return 7.75 percentage of interest. Okay. Now company B is saying that I am paying to bank B at floating rate. Now you should help me as well. So swap bank will say to the company B, okay, I will give you MIBOR equivalent interest rate, right? And in return, you give me 8.25 percentage. I will come to this how these percentages have been calculated 8.25 and 7.75. Okay. As of now, the understanding is that the swap bank will pass on the MIBOR equivalent rate from company A to company B. Clear? The swap bank will pay from company A to company B whatever MIBOR rate is received, and now company B is receiving MIBOR and paying MIBOR. So this will get cancelled, and effective rate of interest for the company B will be on a fixed basis. Right. Similarly, for company A, it is receiving 7.75, paying minus 7, and also paying MIBOR. Ultimately, company A ends up in paying floating rate of interest. Clear, students, till now? Okay. If you are clear, then we will move ahead.
Sir, the last line you have told, can you please repeat it again?
Yeah.
The company,
Yeah. Yeah. So I will, what I'm saying is that ultimately, what, if you understand from company A's perspective, so
yes, sir.
company A is paying 7% to bank A, and
Hmm.
it is paying MIBOR to swap bank. And
Yes,
in turn, it is receiving 7.75 from swap bank. So overall level, if you see company A's borrowing percentage is at a floating rate now.
yes, sir.
And similarly for company B, since it is receiving MIBOR and paying MIBOR, so it gets cancelled, and hence company B is end up having the percent borrowing at a fixed rate. So let me explain it here. I was just about to write this. So after swap, what will be the scenario after swap? Company A, company A is doing what? Company A is actually paying MIBOR, paying 7% and receiving 7.75%, right? So for company A, it is MIBOR being booked plus 7% also being booked minus 7.75 percentage being also taken. Okay. So it will become MIBOR minus 0.75 percentage. Correct. So ultimately, this becomes the effective borrowing percentage for company A, right?
Yes, sir.
So this is the floating rate, right, on effective manner. I hope this is clear for company A.
Yes, sir, clear.
Perfect. Then for company B, now if we see company B is paying MIBOR plus 1% to bank B, right? Which is this leg. It is receiving MIBOR from swap bank. So minus MIBOR, which is it is receiving it, and plus it is paying 8.25% to swap bank. 8.25 percentage to swap bank. So if we see this gets cancelled, so ultimately it becomes 9.25 percentage. 9.25 percentage, it becomes the fixed rate of interest. So the respective preferences have been met, right? Company A,
Yes,
the
sir.
preference was floating. Company B was preference was fixed.
Yes, sir. Actually, I have thought that both are taking on floating rate and now clear, sir.
No, no, no. Yeah, both are not having the floating rate. One is remaining at floating, and second one is remained at fixed. Okay.
Sir, clear, sir.
Yes. Now, if we move ahead, now I just want you to compare. Just a second. Yeah. So I just want you to observe one thing and tell me whether individually has there been an impact. Let's say company A and company B would have not done this entire swap, right? So had doing this swap is beneficial or not doing this swap is beneficial for both company A and company B, basis the data that is there in front of you. Okay, students, if you can observe something and tell me whether if the companies would have not done swap and now if the companies have done swap, which situation is beneficial? Had they not done swap or they should have done swap? Just compare this along with the above case,
Sir, after swap is beneficial to the company.
and the reason is
The reason is, I think, before swap, before sorry, sir.
no, no, say, yeah,
Before swap, company A has to pay floating rate on MIBOR basis only, and now
correct,
the company A has to pay MIBOR minus
correct,
0.75%,
correct, absolutely right, yes.
and
So, yeah,
sorry.
yeah,
In
yeah,
company B, the company B, if it will take on fixed coupon, then it has to pay on 10%, and now
correct.
it has to pay only 9.25%.
Correct, correct, correct. Perfect. So I think this is the gist of the entire swap. See, why have we done this entire arrangement is because now effectively if you see the overall borrowing for the respective companies has gone down.
Yes,
Had they not done this collective swap, they would have been paying higher rate of interest altogether. Okay. I will explain that further, but thanks for that answer. So, the total collective interest payout is actually MIBOR minus 0.75% plus 9.25%, right? So, which is MIBOR minus 0.75, this is company A, and plus 9.25 is company B. So, this is the total collective interest payout, which effectively means how much? MIBOR plus 8.5 percentage, right? So the collective interest payout is coming out to be MIBOR plus 8.5 percentage. However, the option one basis which we discussed the entire swap is MIBOR plus 8%. Correct?
yes, sir.
So where this point 0.5 has gone? So let's say the companies collectively are paying MIBOR plus 8.5, but the banks, Bank A and Bank B, are receiving MIBOR plus 8, right? So this is the interest payout. This much minus received by Bank A and bank B will be MIBOR plus 8%. So net net we are left with 0.5 percentage. This will be, this is going to whom? Can anyone guess? In the entire calculation, where is this zero point 0.5 resting? If you focus here, I hope the query is clear what I'm trying to ask. I'm trying to say that banks only need MIBOR plus 8%, but we have collectively asked company A and company B to give MIBOR plus 8.5%. So where is the extra zero point 0.5 gone? Any guesses, students? Any idea or anything? So this has gone to Swap Bank as commission. Why? Because Swap Bank is not doing a charity. Swap Bank will also expect the remuneration for itself. See, ultimately, Swap Bank has done the entire deal, right? Because Swap Bank only will have the understanding of company A and company B. Then Swap Bank is also assuming the risk for future. Let's say tomorrow, if the company B defaults, right? To cover for all this, Swap Bank will expect some of the consideration.
Sir,
So,
the swap,
yeah,
sorry, the swap bank is third bank or
it can be
fourth?
any bank. It can be third bank. In my example, I have assumed it to be a third bank. Let's say bank C, right?
That, that's
But practically, yeah,
यानी इसी
yeah.
मैंने यानी वो उसका नाम नहीं लिया, मुझे लगा कंपनी ए, ओ सॉरी, बैंक ए या बैंक बी में से कोई होगा इसीलिए।
No, no, no. This is a separate bank in the example.
यस।
Okay. But it can be, I'm saying for all practical purpose, it can be even bank A and bank B also.
यस।
Right? And practically even bank A and bank B can also be same. Right? So I'm saying I'm just trying to explain through this scenario that there are different parties involved. Okay.
यस।
Now
यस।
this 0.5% commission will be kept with the swap bank. Even if it is bank A and bank A is playing two roles, then one is of a lender and second one is of the swap bank. Then also bank A will expect 0.5 percentage on account of the swap bank and bank A will expect the normal consideration on account of the lending. Okay. So this is swap bank commission. Okay. Now effectively what has happened? If you see, now let me come to how these two percentages would have been calculated, 8.25 and 7.75, right? I said that let's keep it pending. Now, what is the overall reduction in the interest in the portfolio? MIBOR plus 8 and MIBOR plus 10, there is a overall 2 percentage reduction, right? Now, this 2 percentage reduction has to be allocated between three parties, right? So, this 2 percentage reduction has to be allocated in three parties. What are they three? One is company A, another is company B, and third one is swap bank, right? Correct? And this has come from option 2 minus option 1, right? Which was MIBOR plus 10% minus MIBOR plus 8%, right? This has resulted into 2% overall gain. Now the way that has been distributed is zero point 0.5 has been kept by swap bank, right? And then balance becomes how much? 1.5. Now this 1.5 has been distributed equally. 0.75 here and 0.75 here. So collectively, they have distributed this 2% in such a manner. Now, it can be in any other ratio also, right? So if they have to distribute this amount of gain, hence this 7.75, how it will be calculated is 7% is the base rate plus 0.75. That means overall 7.75 swap bank has to pay to company A. Similarly, swap bank is receiving 8.25 and zero point 0.5 it will keep it with us and hence 7.75. So I'm saying wherever you pick the equation, it will get tallied. So in this case, 8.25 minus 7.75 difference is zero point 0.5 commission which is kept by the bank, right? Because here MIBOR is received and MIBOR is paid. So it has no impact. But below fixed received, fixed paid, the difference becomes the commission, right? I hope this is clear. Checking with all the students. I hope this is clear, students. Okay, let's move ahead then. Now, if we see three different scenarios, one, there is no swap. Second, there is a swap. And third, there is savings. This we already discussed, but let's just put it. So for company A, if there is no swap, it would have been at MIBOR. Now after swap, it is MIBOR minus 0.75 percentage, and hence there is a saving of 0.75 because of swap. For company B, this is at 10%, no swap. Swap was at 9.25 here, right? After swap, the overall cost become this much, and the saving is 10 minus 9.25 is 0.75. Third party is swap bank. No swap is nothing. In this swap, they have got a 0.5 percentage commission. So overall 0.50 percentage is what they have got a saving. So net net, there is a 2 percentage saving, right? This is the overall savings that they have been able to drive, right? Which is again M plus 10% minus M plus 8%. Clear? I hope this is clear, students.
Yes, sir.
I think sixth question we did. Fifth, third was done. Fourth, fifth, and sixth was also done. Let's come to the seventh question then. I hope this is clear, students, right? So let's move to the seventh question. Have we skipped any question in between? I was under the impression. First, I hope we have not skipped any question till sixth, right? So today we are going to solve the seventh question.
Yes, sir.
Yeah. So seventh question. A Inc. and B Inc. intend to borrow dollar 2 lakh and dollar 2 lakh in yen respectively for a time horizon of 1 year. This one and this one. But B Inc. wants to borrow in yen. Okay. This is the B Inc.'s preference. And the first dollar 2 lakh is the A Inc.'s preference for 1 year. The prevalent interest rates are as follows. If A Inc. wants to borrow in yen, it is 5%. If A Inc. wants to borrow in dollar, it is 9%. Similarly, if B Inc. wants to borrow in yen, it is 8, otherwise it is 10 in the dollar rate. The prevalent exchange rate is $1 is equal to 120 yen. Okay, this is the exchange rate. They entered in a currency swap. Now, please don't get confused, or let's say, please don't get, you know, panicked here. It's still a swap, right? Whether it's a currency swap, it's an interest rate swap. Swap just means exchanging the two legs of any commitment, right? So in our interest rate, how we have swapped is we have swapped the fixed and floating, right? Or floating to fixed, whatever is the case may be. So they entered into a currency swap under which it is agreed that B Inc. will pay A Inc. at the rate of 1% over the yen loan interest rate, which the later will have to pay as a result of the agreed currency swap. So if I stop here and just analyze it, so it is saying that B Inc. This is the only line which is the main part of the question. So this will help you draft your swap. So B Inc. will be paying to A Inc., right? 1% over and above over the yen loan interest rate, which the later will have to pay. Later means A Inc. has to pay. A Inc. has to pay how much? 5%. So 1 plus 5% will be paid as a result of the agreed currency swap, whereas A Inc. will reimburse B Inc. only to the extent of 9%. Clear? Keeping the exchange rate invariant, sorry, quantify the opportunity gain or loss component of the ultimate outcome designed from the resulting from the designed currency swap. Now, this currency swap will mean that they are borrowing in certain preferences, right? Now, if I may ask, A Inc. is having a preference of what? Just a second, students. Yeah, sorry, students. So what I was saying is that A Inc. and B Inc. have certain preferences to borrow. Now, A Inc. has a preference to borrow in dollar, right? Preferred to borrow in dollar, and B Inc. prefer to borrow in yen, right? So if we go with the respective interest rates, so dollar for A is how much? What will be the interest rate? Come on, students, tell
9%.
me. Sorry?
9%.
9%.
Yen, 9%. For B Inc., yen, what will be the rate?
5.
6%. सर वैसे तो 8% है बट उसको स्वैप में 6% मिल जाएगा.
Correct. But let's not talk about swap as of now. I'm saying only as per the plain borrowing. It will be 8%, right?
8%. Yes, sir.
Okay, perfect. So in totality, it will be 17%. Clear? So this is their preferred borrowing mode. But what
Yes.
about their construct of the swap now? Let's come to the swap. Now, if we say that the swap is also telling us in the similar manner that B Inc. will pay to A Inc. 1% over the yen amount that A Inc. will be paying. So it is indicating us that another possibility of A Inc. borrowing in yen is also possible, and B Inc. borrowing in dollar is also possible. Correct? Because the construct of this swap is defined in these two lines, which I am talking about, the first two lines. Okay. So if A Inc. wants to borrow in yen, what will be the effective interest rate?
5%.
Correct. And for B Inc., dollar rate will be
10%.
10%.
10%. Perfect. So collective interest rate will be how much? 15%. So if you see, if I say this is as option 1 and this is the option 2, definitely option 2 is better, right?
Yes.
Yes, sir.
Because here the overall interest rate is less by 2%. Correct? So in case we go ahead with this, and we have to align the respective preferences of A Inc. to pay in dollar and B Inc. to pay in yen. So we will have to do a swap, right? We will have to do a swap. So let me now formally start the solution. So there are two options for designing the swap. Option 1, A takes in dollar plus B takes in yen, and hence it becomes 9% plus 8% is equal to 17% effectively. Option 2, A borrows in yen plus B borrows in dollar, which is effectively 5% plus 10% is equal to 15%. Clear?
Yeah.
Now, option 2 is leading to the most optimum borrowing cost, and hence the same should be used as designed currency swap. As a result, following swap payments are agreed. So A would pay to B how much? It is given in the question, right? So A will pay to B as 9%, which is fixed, right? And B would pay to A as 1% plus 5%, effectively 6%, right? This is what B will pay to A. And if we just want to make it a bit more clear, so A Inc. is borrowing with the yen rate at 5%, A Inc. paying to B Inc. as 9%, and receiving 6%. Here also, swap bank, or let's say I'm just saying because of swap, B Inc. is receiving how much? 9% from A Inc. and B Inc. is paying how much to A Inc? 6%. Clear? And finally, B Inc. is paying for dollar borrowing at the rate of 10%. Clear? So ultimately for A, the overall borrowing cost is 5 plus 9 minus 6, right? So this 5 plus this 9 minus 6, what it is receiving. So this is effectively 8%.
Yes, sir.
Clear? And for B Inc., where this dollar borrowing is concerned, 10% being paid to the bank, 9% being received, 6% being paid. So plus 6% minus 9%, 7%, right? So this becomes in totality 8 plus 7, 15%, which is equal to option 2 overall amount. I hope you yourself would have devised this entire swap.
Clear,
Clear?
sir. Sir.
Yeah. Sorry, any questions?
No, sir, clear.
Okay, okay. Rest all also, I am hoping things are clear, or please do let me know in case something needs to be discussed. Yeah, perfect. Let's move ahead. So this is the swap that we have designed, the currency swap, right? Now they are asking us to calculate one more thing, which is quantify the opportunity gain or loss component of the ultimate outcome resulting from the designed currency swap. So let's calculate the opportunity gain or loss. So how we will calculate this? This will be calculated basis if the swap is operating, then what is the effective amount? If the swap had not been taken, what would have been the effective amount? Okay. So let's see the calculation. Opportunity gain or loss. Let's compute for A first. For A, and since the preferred currency is in dollar, let's do the calculation in dollars, right? The first leg is interest. Sorry, to be sorry, remitted to I'm sorry, B Inc. This will be on $2 lakh, 9% for 1 year, right? So this becomes $18,000. The second part, wherein interest need to be paid to the bank for yen borrowings. Now here please remember students, since the yen borrowing has happened, we have to make use of the exchange rate. So if 2 lakh is the dollar, right? So the amount of loan in yen, let us put it over here. If dollar it is 2 lakh, so yen it will become 240 lakhs, which is 120 yen is equal to $1, right? So basis that exchange rate we have calculated in yen. So this will be 240 lakhs multiplied by 5%, 1 by 22, again converted into dollar, right? So 5% is basically the interest rate that has to be paid on the yen borrowing to the bank. So if we solve this, it becomes 10,000. Then third is interest to be received, right, from B. That is the third leg. So this will be how much? On 2 lakh rupees, 6% will be received for 1 year, right? So we will be receiving how much? 12,000. 18 plus 10 minus 12. So 28 minus 12, in totality 16,000 becomes the, in terms of dollar, interest cost under swap. Since we have to calculate the opportunity gain or loss, hence we have to compare it had we have not done this swap. So interest cost without swap. So 2 lakh would have been borrowed at the rate of 9%, right? Which is the dollar rate for A Limited, for A Inc. 2 lakh into 9% for 1 year. So this will become how much? 18,000, right? And hence the opportunity gain will become, on a net level, $2,000, right? So for 1 year, because of the swap, A Inc. will be able to save $2,000. Clear?
Yes, sir.
The next one will be opportunity gain or loss for B.
Students, please continue. There is a technical glitch, okay, due to shutdown of the electricity. So just wait for 2 minutes, 2 or 3 minutes more.
Okay, so we will B, right? So this has to be calculated in yen. Okay, students, this has to be calculated in yen. So one, B has to pay interest to A Inc., right? I hope I'm audible, right? Students, if you can confirm.
Yes, sir, audible.
Okay, okay, perfect. So B has to pay the interest to A Inc. Let's use the same terminology, interest to be remitted to A Inc. Now the interest will be paid on the notional amount of 240 lakhs multiplied by 6% for 1 year, right? Because we are doing all the calculations in yen, hence we have to arrive at the yen number. So this becomes 14 lakh 40,000. This is the interest to be remitted to A Inc. Now B Inc. has to pay interest to the bank. Interest to be remitted to bank. This will be how much? This will be basis the borrowing rate that B Inc. has taken in dollar. So which will be 2 lakh dollars multiplied by 10% multiplied by the exchange rate of 120, students. Clear? So this will become 24 lakhs. Yen. Again, this we have calculated in yen. We have multiplied this by 120 to arrive at the yen calculation. Then finally, the third part will be B Inc. has to receive interest from A Inc. Interest to be received from A Inc. This will be on 240 multiplied by how much it is receiving? 9%
Right.
for yes, 1 year. So overall, the amount becomes 2160,000. This is the receipt amount, and hence in yen, the net amount comes out to be 1680. If we take a total of above two figures and reduce the third figure of 2160, we arrive at this much. So this becomes net interest cost under swap. This much. Okay. And interest cost without swap. Interest cost without swap will be on 240, the principal amount. We would have ended up paying 8%, right? Which is the yen borrowing rate of B Inc., which is this, right?
Yes, sir.
So this becomes 19 lakh 20,000 yen. This would have been the cost, but we are ended up having 1680. That means 2 lakh 40,000. is the yen savings in the overall interest. So this is opportunity gain on account of swap. Okay, students, any doubt till now? Any other question till now? Please do let me know. Otherwise, we will move ahead to the next part.
Clear, sir.
Clear? Okay. Okay, students. So let's move to question number 8. A textile manufacturer has taken floating interest rate loan of rupees 40 lakhs on 1st of April 2012. The rate of interest at the inception of the loan is 8.5% per annum. Interest is to be paid every year on 31st March and the duration of the loan is 4 years. See, first of all, to be factually clear, they are saying it's a floating interest rate loan. Okay, amount is 40 lakhs on 1st of April 2012. Sorry, the interest rate at the inception is 8.5 and it has to be paid at every 31st March of the year and duration is 4 years. In month of October 2012, which is 6 months after the loan has been taken, the central bank of the country releases following projections about the interest rates likely to prevail in future. The first one is on 31st of March at 8.75, on 31st of March 2014 10%, and the next year 10.5%, and the very next year 7.75%. So they have released the projections as on that date. Show how this borrowing cost can hedge the risk arising out of the expected rise in the rate of interest when he wants to peg his interest cost at the rate of 8.5% per annum. Okay, assume that the premium negotiated by both the parties is 0.75 percentage to be paid on 1st October 2012 and the actual rate of interest on the respective due dates happens to be as they have given the actual rate now 2013, 14, 15 and 16 this much. Show how the settlement will be executed on the perspective interest rate due dates. See, now if you really see which instrument are we talking about, now let us have that discussion in this question. First of all, we are talking about which instrument. Is it forward rate agreement? Is it interest rate futures? Is it interest rate guarantee? Or is it interest rate swap? Come on, students. I want all of you to think through and answer. Basis whatever has been given in the question,
So premium is given, so is it a option?
correct. It's a option. It's for the option. Yeah. Okay. It's an interest rate guarantee. The instrument is talking about on the interest rate guarantee. Now the premium is to be paid as 0.75 percentage, right? Because this is indicating that if premium is paid and the interest cost has to be pegged, that means interest cost will have a cap option here, right? So let's try to put all the facts in a proper manner. Okay, so this we are standing here 1st April 2012, then in the mid of year 1 10 12 there are some projections released which says that in future the interest rate will be higher. So they have entered into a interest rate guarantee or a cap option with a premium of 0.75 percentage, and this is for next upcoming 14, 15, and finally 16th year, right? So one, two, three, four. Four installments that has to be paid in future. So the central bank's projection is how much? 8.75 percentage. This is around 10%, 10.5%, and then 7.75%. And the actual interest rate that is also given in the question is 10.2 here, 11.5 here, 9.25 here, and finally 8.25 here. Correct, students? So 10.2, 11.5, 9.25, and 8.25. Okay, so now let's put the instrument that we are talking about. So textile manufacturer needs to enter into interest rate guarantee, which is a cap option with a strike rate of 8.5% upon payment of premium at the rate 0.75 percentage on 1st October 2012. Clear? So this actually defines that what is the strategy for interest rate risk management. Clear, students? So now let's substantiate this instrument with the calculations. Let's talk about time, calculation, and then finally cash flow. So October 2012, we will end up paying the premium 0.75 percentage on what is the borrowing value? 40 lakh rupees, right? This one. So in this entire 40 lakh rupees, the premium is settled. So this becomes 40 lakh into 0.75 percentage, 30,000. This will become the cash outflow. Then comes March 2013, the first installment. Now tell me, students, the actual interest rate is 10.2. The cap interest rate is 8.5. Do you think this option is favorable to be exercised? If I may ask you,
Yes, sir.
yes. The reason is the market interest rate is higher than the strike rate. And this being a cap option, it becomes clear that if I want to borrow at 8.5 as compared to something that is available in the market at 10.2, so then I will exercise the right of borrowing at 8.5. So this will become 10.2% minus 8.5% for 40 lakhs for 1 year, right? So the amount becomes 68,000 cash inflow. Now this net amount will be received by the textile manufacturer. Textile manufacturer from options exercised. Clear? Then comes March 2014. So March 2014, the actual rate is 11 and a half. The cap rate is 8.5. So still it is a beneficial, it is a favorable option, and hence it will be exercised. So 11.5% minus 8.5 percentage into 40 lakhs for 1 year. So this becomes 3% into 40 lakhs. So 1,20,000 will become the cash inflow. This will also be received. Then comes March 2015. So here, what is the actual rate? 9.25. What is the cap rate? 8.5. Still, there is a benefit of 0.75. Correct? So 0.75 on 40 lakhs is equal to 30,000 cash inflow. This is also to be received by textile manufacturer. Clear, students?
Yes, sir.
Perfect. Now, last one, March 2016. We have 8.25, which is lower than the 8.5. Yeah, sorry. Yeah. So I'm saying 8.25 is lower than 8.5. Now this textile manufacturer will have to pay to the bank because there is a loss. Correct?
सर ऑप्शन एक्सरसाइज नहीं होगा.
Very good. I was checking who is all attentive. So see, this is an option. It won't be exercised. So there is no need to pay to the bank. Yes, Ankita was also replied, I think. So since this is an option, if the interest rate is lower than the strike rate, it will become unfavorable, but we will not have to end up losing any money. Okay? So nil. So March 16, we can just mention textile manufacturer will not exercise the option open market rate should be accepted by the textile manufacturer.
सर
Yes,
जहाँ हमने नील लिखा है, इंस्टेड ऑफ दैट वोंट बी टेक एक्चुअल इंटरेस्ट रेट आउटफ्लो.
just a second, I'm coming to that. So we could have taken, but what we are doing here is we are not calculating the gross cash flows, right? I think this question is from Pooja, right?
Yes, sir.
Yeah, so Pooja, what we have done here is we have not taken the gross cash flows. We are always taking the incremental or the net cash flows, right? And hence I have not taken here any cash flow on account of the option. Okay. But if you
Okay.
are presenting the answer from a gross perspective, right, where you are putting the gross interest outflow and gross, then you will have taken at the rate of 8.25. Okay. I hope clear, students. This is
Yes, sir. Clear.
perfect. Now, I think let's take a break of 10 minutes and then we will again reconvene at 8:31 to discuss the further questions. Okay. We can continue. Okay, so welcome back, students. Let's do question number 9. Drill Dip Inc., a US based company, has won a contract in India for drilling oil field. Okay, the project will require an initial investment of 500 crore. The oil field, along with equipments, will be sold to Indian government for 740 crore in 1 year time. So initial investment is 500 crore, and then after 1 year, the project along with the equipment will be sold to the Indian government at 740 crore. Since the Indian government will pay for the amount in rupee, the company is worried about exposure due to the exchange rate volatility because this is a US based company, right? So for them, rupee is a foreign currency. You're required to construct a swap that will help drill dip to reduce the exchange rate risk. Okay, so they are asking us to construct a swap assuming that Indian government offers a swap at spot rate, which is $1 is equal to 50 rupees in 1 year. Then should the company should opt for this option or should it just do nothing? The spot rate after 1 year is expected to be $1 is equal to 54. Further,
सर ये
you
क्वेश्चन ऑलरेडी हो चुका है फॉरेक्स में क्वेश्चन नंबर 50 था ये टेस्ट
okay,
ऑफ योर
okay.
नॉलेज के अंदर
Okay, no worries, no worries. Then we will just revise it. Okay, but
ओके
let's take this question. Okay, because it might have some of the understandings from the current swap that we have discussed. Okay, so the spot rate after 1 year is this much. Further, you may also assume that drill dip can also take a US dollar loan at 8% per annum. Okay. So now the question in hand is, I mean, I'm just trying to link it with whatever we have studied today. Okay. So Drill Dip Inc. has two problems in hand. One is that it has to invest today 500 crore and received 740 crore. So both the legs has to be covered from a forex perspective, and a swap has to be designed in such a way that the foreign currency risk is negated. Okay, so if I may just write down the facts. So let's say 500 crore has to be paid for investment purposes, and the cash flow is fixed for receiving the 740 crores, right, after 1 year. But this will happen after 1 year. Now, the swap is available at $1 is equal to 50, and the forward rate is $1 is equal to 54. And forward rate is $1 is equal to 54. This is for 1 year forward rate, right? And the interest cost is 8%. 8%. Okay. So the following swap arrangement can be entered. Now let's see that. So the US company will bring dollars from outside, right? Because it being an US company, it will have dollars. So first of all, it will need to swap the dollars with INR so that ultimately INR will be used and invested in the Indian space to have the drilling oil field, correct? So this is the first step that they will do. So this is as on today, or let's say initial let me mention the initial arrangement. Okay. So in terms of the initial arrangement, swap a US dollar loan, or let's say amount, at an agreed rate with the, not with the, let's say directly to obtain Indian rupees to make initial investment. This will be done, right? Then next step will be, after 1 year, the reverse swap will be required to convert the INR into dollars, right? After 1 year, swap back the Indian rupees to US dollars at an agreed rate. In such case, the company is exposed only to the profit earned from the project, not the exchange rate, right? Profit slash loss earned, just a second, earned from project and not due to foreign exchange movements. See, students, the idea here is simple. So let's say this is, what is the name of the company? Drill Dip Company, right? So this company is actually paying dollars, correct? Is paying dollars and receiving INR at the rate of 50, which is the today's rate, right? And after 1 year, it pays INR and receive dollars. The same company. Okay. Now the point that we are trying to make is, if after, so this is today and this is after 1 year, if after 1 year rate is also fixed today, right, then the fluctuations will not impact the earnings of the company. The foreign exchange fluctuations will not impact the earnings of the company, because the dollar earning is already fixed today, correct, which is the basis the exchange rate that is appearing later on. Okay. So in case, now the question is asking us to calculate whether the company should opt for the option of swap or it should just do nothing, right? So let's try to do the calculation basis both the different options available, and whatever is beneficial, that we will finally conclude. So the first is company opts for swap, for example. Okay, let's take the first case where company opts for swap. So what will company do? Today, company will buy 500 crore INR rupees in dollars, right? So that's what the company will do. Let me put here as year 0 and year 1, right? So buy 500 crore INR, which is needed today, right? So this will become $1 is equal to 50 rupees, right? So basis this exchange rate, the dollars will be procured. So it becomes 50 crore, right? Now dollars generally expressed in millions, million dollars. So it will become, so 10 crore is the dollar. So that means becomes it is 100 million. Okay. So 100 million dollars has to be paid in year 0, right? Then what we will do? Finally, we will take the take back this 100 million dollars and again swap it at the rate of 50. I'm talking about the year 1 end. So swap 500 crore at the rate of spot rate, right? So let's say in totality, after 1 year, we are receiving how much? Around 740 crore, right? So this 500 crore, we will swap back at 50 rupees, right? So $100 we will get again back here. This is on maturity after 1 year. And then we will sell 240 crores at the forward rate, which is 54, right? So 240 divided by 54. We will get $44.44 million. This is again $1 million. Any question? Sorry. Okay. Then as a opportunity cost, since the US company has invested $100 million, so it will also expect that opportunity cost of interest also to be built in into the entire calculation, right? So less borrowing cost, because generally what we will assume, either this 100 crore is available as a capital with them and hence there is a borrowing cost, or this $100 million is also borrowed by the company from US and hence it will end up paying 8% of the amount. So it will end up paying $8 million, which is 100 million into 8%. Right? So this becomes how much? This initial cash outflow is minus 100. Then later on, we will receive 100 at the rate of 50. We will receive 44.44 because of the extra delta that we have got of 240 crores, and we will sell it at the forward rate, which is appearing as on today, and minus it on account of the borrowing. So we will end up having 136.44. So there is a net receipt of US dollar 36.44 million. Ankita, okay, wait, let's see that. So we have 500 crore. If we divide it by 50, it becomes 10 crore. So 10 crore dollars will be $100 million. This is okay. This is so 10 crore dollars will become 100 million, right? Because 1 million will have, sorry, 1 crore will have 10 million. So 100 million seems okay. Okay, Ankita? So some of you might be thinking that why have we taken this 240 crore incremental at the forward rate? Because it is mentioned in the question that the swap available by the government is dollar 1 US dollar at 150 in 1 year. Okay, so this is the swap that is available. Okay, so that means you exchange. So what does effectively this swap means? This swap means that today you pay me $1, I will pay you 50 rupees. Tomorrow you return me back this 50 rupees, I will pay you back your $1. Clear? So this is the swap that Indian government is ready to take. Now, whatever extra cash flow this company is generating, it will definitely have to surrender at the prevailing exchange rate at that point of time, which is expected to be 54 rupees per dollar. Clear? So this is around the swap. Now, if let's say the company says that, okay, the second option with the company is I will not take a swap. I will just take whatever the open position that will be there as of today. So instead of swap, what I will do now, I will just focus the entire 740 crore at the rate of 54 rupees per dollar. Because ultimately, this 54 rupees per dollar is what I expect to be the rate appearing after 1 year. So I will surrender entire 740 crore basis this rate and see what is the net impact. So let's take the second option where company opts for no swap. Okay. If the company opts for no swap, then in year 0 and year 1, let's take dollar million here and let's take dollar million here as well. Right. So today they will buy 500 crores at the rate of $1 is equal to 50 rupees, right? So ultimately, again, $100 million will have to be paid initially for the investment. Then, after completing the project after 1 year, it will sell 740 crore rupees using the rate of $1 is equal to 54 rupees. Correct? 54 rupees. So ultimately, after 1 year, we will end up having 137.04. Correct? 137.04. And finally, there will be a interest element at the rate of 8% per annum on $100 million loan. That is $8 million will be the impact of dollar interest. So on a net level, we ended up spending 100 million, but we ended up receiving 129.04 million. So hence the net receipt of $29.04 million is the income. So here we have just gone by the pure play market forces exchange rate, right? We have not considered any swap that is available in question. So if we follow that, our net receipt falls down to 29.04 compared to if we follow the swap, it becomes 36.44 million. Now, can anyone tell me why this has happened? Can anyone tell me what is the root cause why the net receipt is 36.44 in case we opt for swap, right? And in case we don't opt for swap, we are ended up having a lower amount. What is the real driver? What is the main issue over here? If you just think it through, you will get the answer. Just let me know what are your thoughts. I'm just writing the formal answer till then. Since the net receipt, sorry, is higher in swap option, the company should opt for the same. Yes, students, tell me, come on. Have you even will figure it out? Okay, let me tell you then. Is there some response from anyone? No, right? Okay, let me take it up. See, the underlying principle over here is consider this is an Indian economy, okay? And
So
yeah, sorry.
depreciation in rupees.
Correct. That's the answer. It's because of the depreciation in rupees. But how swap has helped to curb against that depreciation is let's do discussion on that. Okay. Now there is an outside company coming into Indian economy and investing some amount. That amount is $100 million, which is equal to 500 crores rupee, right? This is in million. Okay, so this is the amount that they are putting. Okay. But tomorrow, if they want to take it back, right, and do nothing, then I'm saying, let's say they just keep the money and they just want to take it back. And if the exchange rate increases, if let's say the rupee becomes 54 against the same dollar of one, right? Here it was how much? $1 was equal to rupees
50.
50. Now for the yeah, for the same level of INR, you will end up receiving lower dollars. You're getting my point? So you will end up receiving lower dollars because the rupee has depreciated. You have invested in an economy where the rupee has depreciated. If the rupee has been depreciated, you will end up having lower dollars. Now, let's say how much? If I just divide 500 by 54, I will get how much? Just a second. 500 divided by 54. I will end up getting $92.6 million. Correct? So your real deterioration of $100 million has happened here. Because of the swap, what you are trying to say is whatever is your principal amount of 100 million you have invested today, you will get the same amount back. That swap is telling you that whatever you have invested today, you will get the same amount back. Okay. Now, if you really think in swap, who has lost? The government of India has lost because they will be end up paying the
More rupees.
same level of dollars vis-a-vis what they would have ended up paying in the market. Correct? Because they have ended up paying this much difference of dollars higher, right? Vis-a-vis what is appearing in the market. But at the same time, the government of India, I mean, the way to look at this negotiation is they would have built in this loss in the 740 crore payment that they would be expecting to pay. Correct. So, see, ultimately, 740 crore is also linked to what the swap will be, right? So, what I'm trying to say that, let's say if they have given a contract to the internal domestic company, they would have thought that 760 crore is the right value for that contract, right? But because they already anticipated that this fall will be there because of the swap, and hence 740 crore they have pegged the amount to that 20 crore will cover up with the this month. I'm just taking a hypothetical number here, 760, right? So I'm saying this is how the foreign exchange currency impacts will have on your pricing, on your negotiations, even your future cash flows. Okay. So there are different angles to it. I'm just trying to discuss them. But as far as your plain basic swap is concerned, is this till here. I hope this is clear. Any other question or any other doubt?
No, sir.
So then we can move to the. I hope this question, as it was said that it was already discussed, but yeah, it's good to discuss from the overall perspective as well and take a revision to it. Okay. I hope that solution would also be almost similar to this, right? Now let's come to question number 10, students. So IM is an American firm having its subsidiary in Japan, and JI is a Japanese firm having its subsidiary in USA. Now there are two different firms. They have their subsidiaries in the cross currencies. They face the following interest rates. So IM is the American firm. This is the American holding company. It, if wants to borrow in USD, it can borrow at SOFR plus 0.5. And if they want to borrow in JPY fixed, they can borrow at 4%. Similarly, for JI, if they want to borrow in in USD floating rate, they can borrow at SOFR plus 2.5. Otherwise, they can borrow at 4.25. Okay. See, for the understanding of this, we already know that today, being a global, let's say, platform, the companies can borrow in the respective currencies also, right? So let's say today, if Indian company wants to borrow in the US market, they can very well do that subject to the terms and conditions, right? So this is what they're trying to say. IM wishes to borrow USD at floating rate and JY at fixed rate. So they are saying that the preference for IM is to borrow at this rate and JI is to borrow at this rate. Okay. The amount required by both the companies is same at the current exchange rate. So they are saying currently basis the exchange rate, if we convert JPY and USD, it comes out to be the same. A financial institution requires 75 basis points as commission. Can you link it to the discussion that we did? The entire swap bank deal that we have discussed, in that swap bank had kept how much? 0.5, right? Here they are asking to keep 0.75. Sorry. As commission for arranging the swap. This financial institution is actually that swap bank only, as per our example. Okay. The companies agree to share the benefits or loss equally. So they are saying whatever is left after giving the commission to the swap bank, they can share the benefit or losses equally. You are required to find out whether a beneficial swap can be arranged, what rate of interest for both IM and JI? Okay, so I think easier question. So what should we do first of all, students? Come on, tell me. It's a very comparatively easy question, right? What should be our approach in this? How can we first of all determine whether a swap can be beneficial or whether the straight borrowing can be beneficial, or let's say the preferred borrowing can be beneficial? Come on, students, tell me. So in that case, we will have to compute the options, right? The two different options. Option one, if they borrow basis their preferences. Option two, if they borrow in the other than preferences, because only two possibilities are there, right? Whichever is beneficial, we will go ahead with that. But please remember, in case the swap is done, then there is a commission that has to be paid to the financial institution, which is 0.75 percentage. So that also we will have to take into account. So let's talk about IMJI. Okay. IM, there is a USD at the floating rate. That's their preference, right? And for JI, JYS fixed rate. That is also their preference. Clear? So the option one is IM to borrow at floating, which is in dollars, plus JI to borrow in Japanese yen. Let me put as JPY only. Okay, so this is happening at L plus 0.5 percentage, SOFR plus 0.5 percentage, sorry, plus JPY will be 4.25, right? So in totality, this becomes SOFR plus 4.75 percentage. Clear, students? Then the next option is to borrow in the other than preference mode, right? Which becomes option 2. So IM will borrow in JPY plus JI will borrow in dollars. Okay, so which becomes 4%, right? Plus SOFR plus 2.5%. So this becomes how much? SOFR plus
6.5.
6.5 percentage. Very good. Ultimately, this option is giving us the lower amount, SOFR plus 4.75 compared to this SOFR plus 6.5. So option one, so we will go ahead with option one then, right? Option one, option two. So this becomes SOFR plus 4.75%. This becomes SOFR plus 6.5%. So the differential is 0.25, 0.75, 1.75. Yes. So it is 1.75% becomes the differential savings. Okay. Okay, students. So this becomes 1.75. Now this 1.75 has to be allocated. It has to be allocated into different parties. Financial intermediary will end up having 0.75%, right? That is what it is mentioned. So if there is a collective saving of 1.75, now tell me, students, how much will be allocated between IM and JI?
So after this commission charges, the balance is 1 that will be equally shared.
Perfect. So that will be equally shared between IM and share of JI, which is zero point 0.5 and
0.5.
zero point 0.5. Yes. So in totality, we arrive at 1.75%. This becomes the total savings. Since the savings of 1% to be shared equally amongst IM and JI, the interest rates shall be now borrowing from market is happening at SOFR plus zero point 0.5. What is the full form of SOFR? SOFR, we've discussed in the last session. Come on, students, tell me. What is the full form of SOFR?
Secured overnight financing rate, I think.
Yes. And what does this denote? The lending, the rate of SOFR means that for what period the lending is happening. Is it for
Every
6 months?
day changes.
9? Yes. It changes every day, but the
Yes,
tenure of
very.
the is overnight, right? As the name suggests, overnight means for one day. If we give it for one day, then what is the applicable rate? So SOFR plus 0.5 percentage less benefit from swap is 0.50 percentage, and hence ultimately the net interest will be SOFR. And similarly for JI, it will be borrowing from the market is happening at 4.25, right? Which is this one. And the swap benefit is again 0.50 percentage, and hence we end up having a net interest cost of this much. So this becomes 3.75, students. Okay, students, I hope this is clear. Now, I just want to discuss some of the other things with all of you, right? See, first of all, I'm just telling you from a practical perspective. See, there are, for any economy, right? From the quotient perspective, I think we are done. Let's discuss on some of the theoretical topics through which we will be linking the concepts. Okay. So, first of all, students, if you see what is the relevance of, we have heard of that the interest rates actually vary with the different tenures, right? If I talk about 6 month, 12 month, 1 year is already done. If let's say if I talk about next as 5 year, or let's say 3 year first, then 5 year, then 10 year, right? And here I'm talking about 3 months, and here I'm talking about overnight. Okay, so this is the tenure of the borrowing I'm talking about. I'm saying, let's say overnight, if I give a loan to someone, the interest rate will be lowest in this case, or if I give a loan for 10 years to someone, the interest rate will be lowest in this case. Come on, students, tell me. We have discussed this in the previous session. The interest rate is always lowest in which case?
Sir,
The
low.
shorter tenure?
Yes, sir.
Sorry?
As
Yes.
the time period increases, interest rate will also increase. So the for shorter period, it will be less.
Perfect. Now, the reason for that is because if I give someone loan for 1 day, right, the risk is very low that the other party will become bankrupt overnight and will not be able to repay me the amount back. Now, this links to the first part that we discussed, right? Why is interest paid? Interest is paid off because of two things. One is the time value of money or inflation, and the second is the risk of non payment. So, in case of overnight borrowing or lending, the risk is very minimal. Since the risk is minimal, the rate is always lowest. Then it will keep on increasing, and the highest rate will be for the 10-year borrowing, right? It will keep on increasing, and the highest rate will be here. I hope you are getting my point, because in 10 years time there is a huge amount of possibility that there is a higher amount of risk that the other party will not be able to repay me back. Since it is a higher risk, it will lead to higher interest rates. Clear? Now, I'm just telling you a very interesting fact. So, with this, what concept we derive is that always the overnight or shorter period maturity interest rates are lower than the higher maturity interest rates, right? Clear? Similarly, from an investment perspective, also, if you see, so this is a borrowing position. I'm telling you from an investment position also, if you invest for long term, you tend to get higher return if you invest for short term. right? If you invest for, let's say, FD for 180 days, you will get a lower rate of interest. But if you invest for a FD for 5 years with the bank, you will get a higher rate of interest with the same principle, right? Now, what happens if the overnight rate or the shorter maturity rate, so shorter maturity rate becomes higher than the longer maturity rate? This can also happen. Sometimes this can also happen. If this is happening, that means the people, or let's say the investors or borrowers, think that economy is going to collapse in future. Why? Because they feel that there is a high amount of possibility that the longer maturity realizations will not happen. Hence, they will keep on investing. They will withdraw the amount from the longer maturity securities and they will put everything in the shorter maturity securities, which will eventually lead to the higher return, right? So this, if this happens in any economy, this is an indication that that economy is going towards recession, right? So this happened with US in 2008, where the same thing was reversed, right? The shorter maturity rate for those securities was higher than the longer maturity rate, because the people lost their confidence from a long term objectivity, right? From long term perspective, they thought that the economy is not even going to repay us back the principal as well. Okay. So always keep in mind that higher the maturity, higher will be the interest rate as a general phenomena. Okay. Now, if I may say, in the study material, there is one topic on the, there is one theoretical discussion that we have to do on the types of interest rate risks. Okay. So, the types of interest rate risk. Sorry. So, in this, I think the biggest discussion is around this gap exposure. So, students, hear me out carefully. On this gap exposure, what does this mean? So, okay, let's say this is the balance sheet of a bank. I'm just preparing it in the T format. Balance sheet of a bank. Okay. Here, let's say this is the equity and liability side, and here there is a asset side. Okay. Now, can anyone tell me what are the different examples of an asset for a bank? What can be the different types of assets for a bank? Come on, students, keep on telling whatever comes to your mind.
Loans and advances given.
Very good. Loans and advances given. Apart from that, there will be property, plant, and equipment also, right? Some of the buildings, some of the deposits with RBI, cash and cash equivalents. Very good. Ankita is saying cash and cash equivalents, deposits with RBI, right? Now, FNF means, sorry, please elaborate. FNF, what do you mean by FNF? Then we will also have, come on, students, tell me, please contribute to this. So, apart from this, sorry,
Demand.
yeah, demand deposits, fixed deposits, recurring deposits. No, sorry, my bad. These are not assets. So, fixed deposit will be a liability, right? Because the bank, for bank, it is a liability. Whatever fixed deposit we have done, the recurring deposit is also a liability. The savings account balance is also a liability, right? So these are the liabilities. Similarly, in case the bank has done any sort of a borrowing, that is also a liability, right? Borrowing for the purpose of lending. Here, any loan given to company will be a asset, right? Similarly, they will have the equity share capital here, and then finally reserves, right? So this is the balance sheet of the bank. Now, if you see, some of the assets and some of the liabilities will be on a floating basis, right? See, as we understand that the interest rates can be basis floating or can be fixed. Now, let's say loan given. They have given a car loan and they have given a home loan. Okay. So this car loan and home loan will be part of their assets, right? Generally, home loan is for the higher tenure. They will be giving this it on a floating basis. Let's say for 15 years, 20 years, it is given on a floating basis. The car loan is generally for 2 to 3 years. It is given on a fixed interest basis. The EMI is fixed here and basis that the amount gets repaid. Similarly, for home loan also, the floating interest rate keeps on changing. It will basically keep on adding the higher interest rate or keep on reducing the lower interest rate. Okay. Now, if I may tell you that some of the assets and similarly some of the liabilities will be on a floating or fixed basis. So whatever assets and liabilities are exposed to the different interest rates, those are called as interest rate sensitive assets or interest rate sensitive liabilities. Clear? Because here what will happen? If the interest rate goes up on the floating rate of assets, if the interest rate goes up, the income will increase, right? The interest income will increase for the bank. If on the liability the interest rate goes up, can anyone tell me what will increase, expense or income for the bank? Whether interest expense will increase or whether
Yes.
interest income will increase?
Expense will increase.
Correct. Expense will increase. Very good. Yes, Ankita, you're also right. Expense will increase. So for but for fixed it will remain same, right? So the first type of interest rate risk is gap exposure, which we are discussing. Now, what does the gap exposure means? Interest rate sensitive assets. If we reduce it from the interest rate sensitive liabilities. So this difference is called as gap. Okay. And the impact because of the interest rate changes on the financials because of this is called as the gap exposure, students. Clear? So it can be possible that this gap is positive for some companies, for some banks, and this gap can be negative also. Correct? For some of them, the interest rate sensitive liabilities can be higher. So I'm not talking about the fixed rate assets and liabilities here. We have just taken from the balance sheet what is the interest rate sensitive assets, what is the interest rate sensitive liabilities. Hence, it can happen that for a bank, interest rate sensitive liabilities can be higher than the interest rate sensitive assets. Interest rate sensitive assets are greater than interest rate sensitive liabilities here. And here it will mean interest rate sensitive liabilities are greater than interest rate sensitive assets. Now tell me, for a bank where the gap exposure is positive and if the interest rate goes up, then what will happen? For this section, tell me whether the income will go up or down. The net income, I'm telling, the net interest
Up.
income, it will be up. Very good. Because your asset base is higher than liability base. So you will end up receiving more compared to paying less, right? If the gap is negative, what will happen to the net interest income? It will go up or it
Lower.
will go down?
It will
It will
low.
go down,
It
yes.
go down.
Because you will end up paying more on your liabilities because the base of the liabilities is more. Let's take another case where the interest rate is going down. In this case, for a positive gap scenario, the net income will be higher or lower? Come on, students, tell me.
Higher, sir. Higher, sir.
Higher, sir.
No, not higher. Why higher?
Positive.
Because your interest rate is going down in this case. Had the interest
Yes,
rate
yes.
gone up
Low.
in this case, then hence it is lower. Why? Because if your interest rate goes down, you will be getting lower return on your interest rate sensitive assets, and you will have a lower saving on your liabilities. You're getting my point. But ultimately, overall, since your asset base is higher, so overall level you will get lower return. Hence, your net interest income will be lower. But in case gap is negative and interest rate goes down, that means you will end up paying less on the liabilities. So your net income will
Will
increase.
be high.
Yeah. So this is what I just wanted to discuss from the one of the pointers. Yes, Ankita, you're right. You have also responded up and lower. Let me see if there are any other queries to be resolved. Yeah, I think yeah, this is what it is. I think this was the discussion that I wanted to have with all of you today. Any other doubt, students, or any other query? Please do let me know till now. Clear?
Yes, sir.
Clear, right? Perfect. So, from a discussion perspective, this was it from my end on the interest rate sensitive assets. Um, I think there are some further important topics which Ski Ashish sir would also like to discuss. I think he's just a second. Okay, I think he will be there in some time. Meanwhile, what I'm saying is, in this section, if you see on the interest rate risk, right? We discussed about the gap exposure. I hope this is clear. Then similarly, if you go through the study material, you will be also be able to see basis risk, embedded option risk, yield curve risk, price risk, and reinvestment risk. So I think these are the very simpler to understand. Okay, but let me just quickly take you through with the next, couple of things. So see in basis risk, okay, just from the understanding perspective, basis risk is that risk. So for example, in the gap risk, we have given a assumption that let's say if the interest rate increases by 0.5%, all the assets and liabilities will also have the impact at the 0.5%, right? But in reality it is not the case, because it might sometimes happen that the if the interest rate in the market increases by 0.5%, the assets can only increase by 0.3%, or it can increase by 0.6%, and the liability can also have a non-proportionate impact, right? So basis risk means that the the basis point by which the interest rate is moving, the same amount is not getting reflected in the assets and liabilities. Okay, that is called as the basis risk. Then the next risk is the embedded option risk. So sometimes what happens that because of, as I said, that interest rates are dynamic, right? So they also pose a risk to the bank because whatever instruments the bank issues, let's say in some places they will give an option to the person who has been given a loan to repay it back before the expected term, right, of let's say 15 years or 20 years. So there is an embedded option. Embedded option means there is an option with the bank, with the holder, to prepay the amount. The moment they prepay, the bank's cash flow will have a distortion, right? Because the asset and liability mismatch position will be there. The traditional method that we discussed, right? So the maturity profiles will become an issue over there. Clear? Then on the yield curve risk. So yield curve, I think all of you know, in the bond valuation, all of you would have studied how yield curve create an impact, right? So yield curve means the rate of interest, right? So if there is a movement in there which is impacted by the business cycle, will also impact the interest rate risk, right? Now, price risk, right? This is another type of risk. For the price risk, if let's say, as I said, that if let's say we are holding a bond, right, and we sell it before the maturity, correct? Then what will happen? Because of the pricing, right, and prices inversely proportional to the market interest rate, it will have an impact on the interest rate risk, right? And lastly, the reinvestment risk, because if let's say today I am getting back the borrowing proceedings, let's say I've borrowed, I have given some amount on lending and I am getting the amount back, and again I reinvest that amount. So at that point of time, the rate of interest will be different,
Different.
right? So this is another factor of the reinvestment risk from the interest rate risk topic. Yeah, there is some question, Pooja.
No, sir.
Okay. Sure. So I think this was it from my end. Now I request C. Ashish sir to take some of the important topics ahead. Thank you,
Thank you.
everyone. Thank you, sir, for the session.
Thank you, Devas sir. Thank you for
Thank
your
you.
spending your precious time and letting on the students on this topic. Now, students, with this we have come almost come to the end of the topic of the interest rate risk management. Now, if you have any query with the and you can to discuss with Devas sir, you can discuss it with now, because I will take another 15 to 20 minutes to discuss one or two more important concepts. So, if you have any query, so that Devas sir can leave.
Yeah. Yeah.
Student, have you any query that you want to discuss with Devas sir?
No, sir.
Okay. Okay, Devas sir, thank you
Okay.
very much. Now you
Sure,
can
sir.
leave. I
Thank
will
you.
take other section for
Thank you, sir.
further. Thank you.
Thank you, sir. Thank you, sir. Thank you. Thank you.
Okay, student. Now we have discussed the topic of interest rate risk management, and as we have our in our earlier discussion, our you have seen we have discussed the topic of derivatives. Okay, then we have discussed the topic of foreign exchange risk exposure. Okay, now we are today in last class and today's class we have discussed the topic of interest rate risk management. Now, in all this topic, you have seen that there are some derivative techniques that we have covered here, like forward, futures, and options. So all techniques we have covered there. Now, see what happens. We have discussed the concept of option. Now we have seen its application in forex as well as in interest rate option. Now, when we talk about the interest rate option, there is one more strategy, and that is very popular strategy, that is called collar strategy. Okay, student. Now, this strategy basically involves, you can say, we can generally buying the call option and selling the put option. Of course, generally the option purpose to buying the call option is basically to hedge the interest rate risk, especially when you are borrowing the money. But sometimes what happens, since option is attached with the premium,
So sometime to avoid the premium cost, what we do, we sell the put option, because what happens, generally whatever the premium we are paying by buying the call option, that is compensated partly or it may be fully compensated. So it may be compensated by this selling the call option, because when we are selling the put option, of course here we are receiving the premium. Okay, here we are paying the premium, so they are offsetting by each other. So I have take up one question, and this question was in earlier our practice manual, and now this question has come into our earlier exam as well. So I am discussing with you the how it has been solved in our earlier exam approach, and this is a correct approach. So of course I will upload the question after this session. Just now you look at your screen. Just read the question carefully so that I can start further. It says like that MPD Limited issues a rupees 50 million floating rate loan on 1st July 2018 with a resetting of coupon rate every 6 months equal to MIBOR plus 50 basis points. MPD is interested in an interest rate collar strategy of selling a floor and buying a cap. Okay, so collar strategy is equivalent to this much. Now MPD buys 3-year cap and sells 3-year floor as per the following detail on 1st July 2018. Now principal amount is rupees 50 million, 5% floor, the rate strike rate is 5% floor and 8% for the cap. Okay, it means if now it is here very important, because we have to see when we are buying the cap option, when we have to exercise it, and when we are selling the put option. So it will be the other party that who will exercise. Now you don't have the option. When you are selling the option, you don't have the option. The right of the exercise lies with the other party, or we can say it is the holder of the option, buyer of the option. Now reference rate is 6-month MIBOR. Now premium is nil since premium paid on cap and floor is same. Generally it can be vary, because sometimes premium may be higher or it may be negative, but generally in most of the cases it has been considered that generally cap premium is more and floor premium is less. The reset date and the interest rate per annum on that dates are. Now what happens, see, he has bought the option, he has entered into the collar strategy on 1st July 2018. Now what will happen after entering into the strategy? Now every at reset date is falling on after every 6 months. So now these are, you can say, these are the actual rates, or we can say actual spot rates. So these are the actual spot rate. This rate is on 31st December 2018. This is on 30th November June 2019. This is 30th December, 31st December 2019, 30th June 2020, 31st December 2020, and 30th June 2021. Okay, now using the above data, you are required to first the effective interest rate paid out of the 6 reset dates rounded off to the nearest rupee. Then average overall effective rate of interest per annum rounded off up to 2 decimal point. Now student, please note that it is always, please remember that whenever we are entering into the derivative or any kind of a transaction, generally this is a transaction in addition to our main transaction. Now here our main transaction is that we have issued the 50 million floating rate loan on 1st July 2018. So this is a totally separate. Now this arrangement is totally a derivative arrangement, and that is for the hedging purpose. So this is separate and this is separate. So we shall see, first we have to see how much we have to pay. We have to pay, how much we have to pay? MIBOR plus 50 basis
50
points.
basis points.
Yeah, 50 basis point. Okay, 0.5%. Okay, beta, is clear?
Yes, sir.
Okay. Any doubt, beta?
No, sir, I was just confirming with
Okay,
you.
yeah. Is it because they will pay, and see on now I will tell you how it is computed. It is very important because you have to pay the attention here. So we can say that Okay, now we have to first we have to write payoff of each leg of option. There are two legs. One is cap. Okay, for cap, you know that cap you can say that maximum of 0. Okay, notional principal, or we can say that MIBOR strike rate, MIBOR minus MIBOR on reset date, we can say minus strike rate, cap strike rate. Okay, into notional amount, because here why we write the notional amount, because we are only just derivative, we are trading only on it. Actual loan amount has not been exchanged, please always remember. And number of into number of days of settlement, days in settlement period. It is very important, we have to see what is settlement period. And the total number, say we can say it is a 365. So by this we can compute the leg pay of our call option. Similarly, we can find out the put option, because we have to see that put option will be exercised by other party. Okay, and of course, see, now I just give you the, if you see this here, our MIBOR on a reset date and minus strike rate and 0, whichever is higher. Of course, our strike rate is basically 8%. Okay, the MPT limited will not exercise its option, unless and until the MIBOR rate exceeds the 8%.
8%. Okay.
Yeah, yeah. Okay, so because only then this will be satisfied. Okay, on the other hand, since we have sold the put option at 5%, okay, it will be exercised by other party when the rate will be below the 5%. Okay, so accordingly, our leg will be similarly 0. Okay, floor strike rate minus MIBOR rate on reset date into notional amount into number of days in settlement period. Now, settlement period, how it will be calculated, I will tell you. Just have some patience. Divide by 365. Okay, student. So now we move to the how we compute the period. Scale आता है इसमें जीत. Scale आता है इसमें नहीं आता. चलो. Now let us draw the table. Okay. 1, 2, 3, 4, 5, 6, 7, 8. Now first we write reset date. See, in a reset date means it is a floating rate concept. On that date, what was our MIBOR? It is in percent. Okay, date of payment. Okay, now here our interest, days. Here it is days, number of days in the period, settlement period, number of days in the settlement period. Now here we see interest payment. Okay, that is MIBOR plus 0.5%, because it's a 50 basis point, and 1 basis point is, you know, that is equal to 1 divided by 100. Now here it is very important. Cap, for cap it will be receipt. Okay, for payoff it will be payment. Okay, for floor it will, sorry, for cap it will be receipt, and for floor it will be the payoff, because you have sold the floor option. Now effective interest. Okay, now see, this is the one part of the story, that we have borrowed the money from outside and this much we have to pay, and this is the other side of story, that what we have entered into the hedging strategy. So the everything related to the same will be come here. What will be the hedge? What will be, so effective interest will be this here only. Now we come to first date, 31st December 2018. On this date, the MIBOR is 7%. Now student, very important. This on a reset date on 31st December 2018 means the period of settlement, or we can say period of to which we have to pay the interest, will pertain from 1st January 2019 to 30th June 2019. Okay, accordingly our payment will fall, because it is a floating rate concept. This payment will fall on the 30th June 2019. Okay, now very important students, I need your attention. See, this is a forward looking concept. First of all, we have to see that it is a forward looking concept. On 31st December 2018, whatever be the rate of interest, that will be applicable for the coming 6 months. Accordingly, for the settlement period, we shall consider the days. I am just writing on a separate sheet. On 31st December 2018, days will be counted like this: for January 31, February 28, for March 31, for April it is 30th, or for May it is 31, and for June it is 30 days. So total comes beta 181 days. Okay, so we will pay the interest for the period of 181 days here. Okay, of course, our effective rate of interest of our MIBOR is on that date is 7%. Of course, I will pay for $50 million, for 50 million rupees. I will pay the interest at the rate of 7.5%. Okay, so if we calculate, please remember, and this period will be, you have to calculate like this. I just show you. See, our amount is rupees 50 million into 7% plus 0.5% into 181 days divided by 365. Now, please student, just calculate the figure and let me know. I'm waiting for your message.
So 1.8595
1 point.
million.
No, you just convert in full amount. Just multiply in the whole numbers, you can say.
So 18 lakhs,
Yes, 18 lakh,
59,000,
59,000.
589.
Very good. Okay, student. So here the amount comes 18 lakh 59,589. So this is a part of payment that we have to make to the lender who have lended their money to us, to M&D. Okay. Now we see whether we shall exercise our option. Now see, our strike rate is 8%, whereas in market it is 7. So we lap our option, let be the lapsed. Okay, whether the other party will exercise its option, because in
No, sir.
yes, no, because in the market the rate of interest is 7%. Of course, he will not exercise at 5%. Is that clear, better?
Yes, sir.
So both options are not exercised, neither exercised by MN, this is company, and nor by the. So ultimately, this amount will be, there will be no payoff, nothing will be there, and ultimately it will be the effective rate, effective interest I have paid for the this same settlement period. Okay, student. Now we come to the next reset date, that is 30th June 2019. True. Now rate comes out to be at that day 8%. True. Here it is on 8%. So of course we shall not exercise this cap option. Okay, because it is not more than 8%. And here we shall not exercise, the other party will not exercise their option because it is less than so of course we can say that nothing will be on the part of our hedging strategy. Now here the period will come. Now 30th June is there. So the period comes like this. Student, please remember, I am just writing down period only for your understanding. You know not to reproduce the same in your examination. You can just, but reconfirm it. Don't just make out some rough working, okay, or just small working. You can, but make sure that number of days should not be mismatched. It is very important. Okay, so here the period will start from the 1st July 2019. So number of days will be July this. Okay. Now here the
One,
number of yes, better. Any doubt?
184.
Yeah, 184 day. Very good. Okay. So overall 184 days period will be there. So we accordingly we calculate here the date of payment will be 31st December 2019. That is for this period, and number of days during settlement period will be 184 days. So just calculate the amount and let me know. 8.5%. Please remember, the amount will be, the interest will be 8.5% because I have to pay plus 0.5%.
So the calculation will be original amount plus जो earlier interest था उसका cumulative करके होगा.
Not cumulative, beta, not cumulative. Only for the these days. Only
Okay,
for
sir.
one, because we have already paid this amount. This date of payment indicates that you have paid one installment of interest of the this first installment. You on 30th June 2019. Yeah, Ankita. Yes, beta, you are correct, Ankita. Only hardly rounding off, no matters. Don't worry about the same. Ankita, your answer is correct. Any other answer? Okay. Yes, Ginny, your answer is correct, beta. Ginny, I think you just have to need more calculation because little bit 21. I think, yeah. Pooja, now your answer is correct, beta. Ginny, I think there is only one decimal points, maybe difference there.
Yes, sir, I have
Ah,
rounded.
yeah, only there is one difference. Okay,
Yes.
but you are nearby the answer. Okay, students, so the answer comes 21, 42, 466. I am writing here. It may be 465 or 467. Don't worry about the same. Okay, I will rounding off. I will tell you the rule. There is nothing hard rocket science here. I will tell you because see, if it is somewhere around five more than 50 paisa, around 50 paisa, you can round it off on a higher side. If it is less than 50 paisa, you can round it off on the lower side. Okay. Okay, now here nothing will be exercised. Now we come to the third day, third period, that is our period start from the 31st December 2019. Now here I need your attention. Okay, very important. Here I need your attention, because when I will write the days here, you see, now the period start here from January 31. Okay, here very important, since because our period will start from the 1st January 2020, it will be a leap year. Very important, very important. It will be a leap year. So number of days will become 29. That's need very important attention.
One 82 days.
Very good, beta. Okay. Now here again we come. Now question rises, whether option will be exercised. None of the option will be exercised, nor the company will exercise, nor then even the buyer will not exercise. So nothing will be exercised. So ultimately we calculate there will be no exercise here, and our period of interest will be 31st December 2019. Okay, our rate of interest is 6%. Okay, date of payment is 30th June. Number of days will be 182 days. We have computed here number of days 182 days. So now you tell me the amount of interest, beta. Beta, I think there is small. Pooja, you again check it. 182 days. Ankita, you are also right, but let me check. Yes, I want you commit this mistake. Yes, I'm sure everyone is committing. Just have some pay some attention. I need here your. That's the correct point here. Ankita, Pooja, you have make calculation in a correct manner, but there is some mistake. I'm just hinting it is in denominator. Yes, Ankita, now you are right, beta. It is in the denominators. Yes. Now, Ginny, you are correct answer, beta. Very true. Ankita, now you are true. Your answer is correct now. Pooja, beta, yes, you are now right, correct. Very good. Now, see here, student. When I told you it is a leap year, okay, in the denominator, when we will calculate the interest, okay, so our interest will be like this, rupees 50 million into 6.5% into number of days 182 divided by 365. It is very important. Oh, sorry, 366. I just write it again. It is 366 days. It is very important. Now this have to remember, and normally student commit the mistake in this type. Okay, clear, beta? So here the amount comes 16, 16, 120. Again, nothing will be there. So 16, 120. Okay, so it goes like this. Now we come to the next day, that is 30 June 2020. Okay, our rate of interest comes around 4.74. Now here our date of payment is 31st December 2020. Okay, now here our days number will be, see here, if you will calculate, okay,
184.
184, very good. Okay, it is the same. So 184 days will be here. But here now option will be exercise. Now question rises, who will exercise the option? Of course,
Lower.
Yes, buyer will be the exercise option, because here the strike rate is 4.75, and here strike rate is, sorry, spot rate is 4.75 and strike rate is 5%. Accordingly, the buyer will be the exercise the option, buyer of the option. Now, what will be the interest amount? How much will be the interest amount that we have to pay? Balance amount we have to pay 0.25%. Just compute the amount, beta. Yes, interest amount is okay, beta. Very good. Now it is a compensatory amount. I think Ginny, just somewhere nearby, just you recalculate it again. It is coming. One or two students give me the confirmation. Uh, yes, yes. Now Ginny, now you are correct, beta. Okay. So Ankita, your interest amount is correct, beta. But we have to compute the compensation amount. Okay, our compensation amount comes that we have to pay 62,48842. Clear? Now here interest amount is 1319,672. Okay. Here it will not be there. So ultimately, what will be our effective interest? This plus this, because we have to pay this amount. This we are already paying in the market. Okay. So ultimately, our amount comes 13,82,514. Okay, student. So we can see here that the total comes 366. Here it comes 365. It also help us to locate our mistake if we have committed in the examination. This is the check we can apply. Now we come to the second last day, that is 31st December 2020. Okay, effective rate is the spot rate is 4.25%. Okay, number of days here will be 181 days, because here there is no leap year. I am writing down the here amount, okay, because time is only 5 minutes or more, but you can calculate at now. Here we have to calculate the compensatory amount, okay, that you can calculate. I am just writing down here rupees 50 million into our spot rate is we have given the sold at 5%. So our just give me the answer. Yes. Yes.
185,959.
Yes, Sahil, you are correct, beta. Yeah, yeah. Who has told beta? Pooja, you were told what is the amount, beta?
Yes,
One.
185,959.
Yeah, yeah, correct, beta. Sahil, you are correct. Jeannie, you are also correct, beta, and Sahil also correct. So the amount comes 185,959. So again, we have paid this much of amount. Total we comes here. Okay, now we come to the last period, that is 30th June 2021. Clear? 5.25. 31st December 2021. Here number of days will be 184 days. So you can check it is 365 days. Here the interest comes 14, 49, 315. Now here nothing will be exercised by company as well and buyer as well, because the rate of interest is more than 5%, and from the cap option point of view it is less than 8%. So total amount comes 14 lakh 49,315. Okay beta. Now total comes beta 1998 lakh 13,000. So this much of interest we have paid overall. Now next it says how much effective interest will be us to, if we calculate by the number of annual interest, we can say that. So it comes 98 13 703. This much of interest we have paid for how much days? Now we total here the number of days. Okay, the number of days come here 1096. So total number of days, for this number of days we have paid this much of interest. For annual we will take 365, okay, into this much of interest we have paid for the 50 million, means 5 for 5 crore we have paid this much of amount. For 5 crore we have made this for how many days? This much of days. Now we want to calculate it for the 1 year. So we divide it by number of days, we multiply by number of days in a year into 100. Okay, now figure comes, just let me know. Yes, very good beta. Ankita, your answer is correct beta. Nearby your just small difference, it may be possible, no problem.
6.54.
Yes beta. Pooja, you are right beta. So answer comes beta 6.54. Yes Ginny, you are correct beta now. Okay student, so with this I hope the question must be clear to you. If you have any doubt relating to this concept, you can discuss with me. Okay student, now in this assignment you must have noticed that we have not used the word LIBOR. Now see, LIBOR is no more in use, so we are now trying to uh, not replacing it with the some other reference, alternative reference rate. This alternative reference rate can be SOFR, Sonia, Esther. Okay, it can be Tonia, because normally SOFR is for the dollar LIBOR. Okay, and so for Sonia is for LIBOR pound borrowing generally Sonia is used. For LIBOR Europe is Esther used. So this is already mentioned in your study material. So please go through the study material as well, because you will get to know the LIBOR is no more in the use. Of course, in the exam, if in question LIBOR has been given to you, so don't use any other word, just use a LIBOR there, because in the examination it has been mentioned. Okay, so because don't add your, if SOFR has been mentioned, then use the SOFR. So whatever, see, please note that it is normally the benchmark rate. Whatever the title to is given to the benchmark rate, you have to same reproduce in your answer as well. Okay, so with this student we come to the end of this session. Okay, if you have any query, of course, as you can send your query at our email ID 01. You can contact me over the telephone this at this number 0120 956, or you can send your query at sfm-final @ICAI.in, or you can send it through the mobile app as well. So student, with this we come to the end of the session, and thanks for patient listening. Now in the next class we shall come with a new topic. Okay, we shall come with a new topic. So till then, revise whatever we have discussed in the class. Thank you very much. Okay, have a nice day.
Thank you, sir.
Thank you beta.
Thank you, sir.
Thank you beta. Thank you. Okay, Ashokji, session is over. Thank you.